Hello everyone, welcome back to Upside Down Data. Today I want to talk about the Bitcoin rally. So far, so good. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter, where we put out regular updates about our risk indicators and more. So to start off our discussion today, I want to talk a little bit about Bitcoin's price action and some reversal indicators that people follow. Then I'll go and talk a little bit about some of our indicators, the momentum bias indicator, the upside downside potential indicator, and then talk a bit about the stock market and some supply related things that I'm watching. So to start off with the price action of Bitcoin, if you've been following the markets, most people have been quite happy to see this strength, although not everyone really believes that it's for real yet. We seem to have put in a local bottom, at least for now, down at around 33K, and we're now trading at 44K. So a nice move to the upside there from that absolute bottom, right? We're trading a little over 30, around 34% up from that local bottom, the absolute bottom of that wick there. But I think the question everyone's asking is this going to be a extended rally like what we've seen before, coming out of the summer of 21 or coming out of, late September of 21 into a more meaningful rally? Or might it just be something like this fake out we saw around Christmas that's just going to fold over and fall off? So the first thing I want to talk about is a couple reversal indicators that I've seen different people talking about and just show where we are with those. So one of the indicators that people talk about a lot is the super trend indicator, which is this this market trend type of indicator. And what you can see is that it, generally speaking, does seem to do a reasonable job of identifying these uptrends and these downtrends and these uptrends again in the market. So that's one reason why people like to follow this, to see what it thinks. You'll notice, for example, with the super trend indicator, we did not flip green or flip into an uptrend in that kind of fake out around Christmas of 21. But in the last couple of days, we actually have flipped into kind of this uptrend category, right? We were able to push up far enough to flip the bias green. So now this indicator says that from its perspective, we're now in an uptrend like what we've seen before. Now, obviously, it's possible for this indicator to not always be 100% correct. For example, some of these uptrends it called here, while technical uptrends were not particularly meaningful in the grand scheme of things, coming from this candle here to this candle here. Well, in fact, this candle here actually was just a down. You would have been down overall from that period. So it's not always going to call things perfectly, but overall it does seem to do a fairly good job. And so certainly you'd rather see this flipping green than have it continue to be red. That's certainly a hopeful sign, an optimistic sign. So another one that people have talked about a number of times, or I've been seeing a lot of people talk about, is the weekly Heikin-Ashi candles. So these are another way of, These are another way of just looking at trends in the market. And what you can see is that generally speaking, when you're getting these green weekly candles, that tends to denote upside. So when you're kind of getting those first few weekly candles that are green, oftentimes bigger trends have followed. Same thing with red moving on down. You'll notice that we flipped, we closed a green candle at the end of last week, and we're currently now putting in a green candle. Now, I've seen some people talk about how with these Heikin-Ashi candles, these kind of Doge candles here, these ones where they just have like the open and close very close with big wicks on top and bottom, as not being particularly diagnostic yet of a reversal. And so you really would like to see one of these kind of shaped candles to really kind of confirm it. And so we'll have to wait and see, if this weekly candle can close that way. Now, obviously, one of the things is that the longer you wait for these additional confirmation signs, obviously the more upside's already gone, the less continued profit to realize, right? The more of these candles you wait, then the less upside oftentimes will remain. But of course, you're taking on more risk by jumping in earlier. So that's just always the game that you have to play here, that the earlier you get in on signs of a reversal change, the more potential upside there is, but then also the riskier it is, because downside is more likely to actually follow. It's more likely to be a fake out, and then downside could happen after. So just something to always keep in mind with all of these different indicators is that, we're all just trying to make our best guess about what the market's doing or where it's going or if we've hit a bottom. But obviously, the earlier that we decide to act on that, the more risk that's inherently being taken. So those are a couple reversal indicators that are both flashing bullish right now. And of course, we'll have to wait and see what happens. But those are certainly more optimistic, or an optimistic additional data point that we didn't have at times like the fake out around Christmas. Now, the next indicator I want to show, again, I talked about this recently, is the Fear and Greed Index. And this is an index I like to follow just because with rallies, oftentimes, rallies get their start in really bearish times, or at least in bearish sentiment, right? It's usually these points where you have super high fear in the market that set the stage for nice rallies moving into the future. And that's certainly what we've seen here. Now, of course, fear had been quite low, or excuse me, fear had been quite high all the way through this correction, but it's possible that now we've kind of found our bottoming point. And it is useful to note that, except for this score of 10, this score of 13 was kind of the lowest score we had seen on this indicator. So it seems like reasonable from that perspective that if a lot of people are fearful, sometimes that suggests that enough of the sellers have been shaken out. The sellers, everyone who's going to sell has sold for the most part, or most people who are going to sell have already sold at those prices, which can indicate seller exhaustion, which then can suggest that upside is kind of the path of least resistance. Now, one of the things that I'm personally looking for as we go through this rally, if assuming the rally continues, of course, is how quickly we flip from fearful, these zones down here, up into greedy. Because one of the things that oftentimes you want to look for in these kind of reversal points is, in some ways, disbelief is bullish. The more people who are disbelieving the rally, oftentimes the better it is for the long-term the upside potential that could be expected from that particular rally. And one of the reasons for this is the derivatives market that you always have to keep in mind, especially in the current conditions where spot demand is quite low. Derivatives have an outsized impact. And of course, when people are going long on the asset, when they're betting on the price going higher, then you have to be worried about those liquidations that can push price lower, right? When people are betting long, price moves too far against them, they get liquidated, that creates sell pressure, which then dumps the price kind of artificially. And so if you get just a ton of people suddenly putting in longs in the market, that just means that it's a lot more sensitivity to small pullbacks that could liquidate a bunch of people, create a cascade, and push price down. So really, from the derivatives perspective, you want people to be piling in shorts right now. You want to be people betting against the market right now. And the longer that people bet against the market as price goes up, the better. That's actually kind of what happened throughout this run coming out of the summer. That people didn't believe this rally for a while, and then a bunch of shorts got liquidated, which created a bunch of buying pressure that then catalyzed our move way up from around 30K, up to 52, 53K a couple months after that. And so that's one of the things I'm looking for. And I personally would like to see this fear level the fear and greed index stay low for as long as possible, right? That's what I want to see. I want to see something more like this happen, because if we flip too quickly to the bullish, that could just mean that a bunch of people are going to come in on the long side, which can set us up for liquidations. And also, of course, there's just other people who'd probably just be getting out of the market if they sense that everyone's getting too bullish. They'd sense that it become unsustainable, and people, even in the spot market, might be exiting at that point. So the more disbelief, the more sustainable these rallies sometimes can be. Not always, certainly not guaranteed. And obviously, during parabolic runs, you can sustain high greed levels for quite a while. But in these kind of low demand situations, I personally prefer there to be a longer period of disbelief to be more optimistic of upside here. But that's just my perspective. Now, a final derivatives-related indicator I want to talk about, which I think is just a really interesting one, not on its own, I think, especially diagnostic, but just something useful to keep an eye on, is this idea of this point of max pain in the options market surrounding Bitcoin. So if you're familiar with options, essentially what options are is they're a form of derivatives where it's essentially different contracts that are written, that people buy, that give them the option to either buy at a certain price in the future or to sell at a certain price at some point in the future. So all options will have some kind of expiration date. We're looking right now at the ones that expire tomorrow, so on February 8th. And so the idea with an option is that there's two different sides, obviously. So if you're not familiar with options, there's call options and there's put options. A call option gives you the option to buy the asset at some price at some point in the future, and a put option gives you the option to sell at some price in the future. And so with a call option, you're really betting on price to go above whatever the price is, that's your strike price. That's that kind of critical value. So for example, people right here, these are people who have call options who the strike price is at 43,000. And for them right now, they would be what's called in the money, because for them, if the price does close above 43K, right now we're right around 44K, if the price closes there at the end at tomorrow, or going at tomorrow when their their expiry is, they would have the option of selling, or excuse me, buying Bitcoin from the other person, the other half of this contract. They'd be able to buy at 43,000, and then they could just sell in the open market at 44,000. It'd be guaranteed profit for them to do that, and the other person would take a loss because they'd be having to sell below market value. Whereas for the put options, they want price to go down, because if you have a put with a strike price of 43,000, but then the market's at 42,000 at your at that point of where you could exercise your option, then what you can do is you could buy in the open market at 42,000, and then sell for 43,000, make a profit. So that's just the way these options work, right? And if you're buying call options, you want the price to be above, so that you could exercise your option to then sell and make a profit. Whereas for put options, you want the price to go below your strike price, so that you could buy at the open market and sell for that value. So that's the way that works. But the idea with these options is that, of course, for everyone who's buying the contracts, there's someone who's writing the contract, right? There's someone who would have to be on the other side of those exchanges. And the way that they make money is that there's a premium. So whenever you buy one of these options, you have to pay, think of it kind of like a down payment. You pay the option writer some amount of money to give you the right to buy or sell in the future at whatever the price is, depending if it's a call or a put option. And then the idea is that for the person who's writing the contract, they just don't want you to be able to exercise your option. You know, they want to be able to keep that premium that you paid for the right to buy or sell at the future time, and they don't want you to be able to exercise on it. So they don't want. So if they wrote a call option, they don't want price to be closing above your strike price, because then they'd be losing money. They want it to close below, so they can just pocket the premium and just make money, not have to pay out on the other side there. And so the idea is that you can calculate this thing that's called the max pain price, which is the point at which people who are buying buy or call or put options will be losing the most money, and then the people writing those options will be making the most money. So this is maximum pain from the perspective of people buying options. And so this is kind of aggregated across the whole market. And so it's possible, by knowing the amount of open interest that's out there, the distribution between call and put options, and the strike prices, where that point of maximum pain is. And there's a theory that the people who are writing these options are oftentimes kind of people with a lot of capital to throw around, right? They're kind of the market maker type of people. And so for them, they're motivated to keep price close to that max pain point, because that's when they are going to make the most money. The people writing the contracts will make the most money if the price is close to this max pain point on average, or in the aggregate. And so you can sometimes think about these max pain points as being kind of like a magnet, right? That in a really low liquidity market, or low kind of spot demand, spot volume market, it could be then that those kind of people, the market makers, the people who have a lot of capital to throw around, can then do what they can try to do what they can to keep the price close to the max pain point. So sometimes that can mean that if price is below the max pain point, that can be a sign that maybe there'd be some buying pressure by this expiry day to get those people into that maximum amount of profit point. And then likewise, if price is above, like we are right now, maybe that could create some short-term selling pressure to get price back down to that max pain point. Now, again, I don't think you can't take this in isolation, because obviously the people writing these contracts are just one player in the market. There's a lot of other people participating. If there's a sudden surge in buying or selling in the spot market, it's unlikely these people on their own could overwhelm that, or even that they necessarily always be in their best interest to do that. You know, it could be that they'd be losing money, more money by doing that for other reasons, if there's some extraneous event that's really causing demand to move quickly. But in kind of more low liquidity environments, or where there's not this kind of overwhelming amount of spot buying or selling, then this can just be one thing that moves the market towards a specific price. So just something to keep an eye on. And I think this is interesting that, 43,000 is certainly below where we are right now, but it's certainly a lot better than 33K. And so you can see this as not being especially concerning, right? If the max pain price would be considerably lower, then these people would be motivated to push price down quite a bit more by that point. Not to say they'd be able to do that, but they would be incentivized to have price be lower. So having it being this close is not something that's especially concerning, in my opinion. And then you can also go into the future and look at what those max pain points are. And so you see that even just the next day, it's back at 44,000. You can go to the future. And these values can change as things evolve, because the number of contracts and what side they're on can change over time. So just keep that in mind. But you can look out into the future. This is kind of a useful tool just to get an idea of where things currently are. And by the way, I'm getting this data from coinoptionsstrat.com if you're interested in checking this out for yourself. Okay, so that's just a couple things I'm looking at more for short-term oriented, right? This idea of these trend reversals, fear still being relatively high, but not as high as it was before. I'd like to see that stay low as long as possible. And then also seeing that the max pain price isn't super biased against us right now, which could just be one other positive sign. Although certainly it is currently below the current value, though it seems like even just by the next day it's at around where we're trading. So what I want to talk about next is just the momentum bias indicator, give some more perspective. We've been talking about this indicator for a while on this channel. I just want to give another update. So the last time I updated about this, we had seen this start to reverse. Right now, we've actually seen the reversal continue. So what this indicator is telling you is basically the amount of positive or negative bias that's present in the market. And when you have positive momentum bias, that's anything above 0, that tends to occur when you're in these uptrends. The more time you're spending in these upper levels of the MBI, the more likely you are to be kind of in these uptrends that lead to these blow off top type points. And if you're spending a lot of times in the negative, that tends to suggest kind of bearish times, and that kind of could drag the price down. And then you have to slowly regain that positive momentum bias to be able to shoot back to the upside. So we've been in a pretty extremely negative momentum bias point in the market recently. You can see that we've only been down at these same levels a few other times in Bitcoin's history. But it seems like we're putting in a nice reversal here. So what I'm going to be looking for is this to get back up to 0 and have us actually be able to reclaim an overall positive momentum bias. Because if we can start doing that and we can start kind of putting in these oscillations around 0 that then slowly get more and more into the positives, into these blow-off topping points, that might suggest that we're building into a parabolic run, which is really, I think, what most of us would like to see coming out of here. So far so good on this, right? This is doing what we'd want to be seeing. We're just going to have to wait and see if it's able to continue going up or if it gets rejected off of 0, which could be a bearish indication if that happens. Another relevant data point, I think, is just look at our risk indicator, the upside downside potential indicator. So this is the long-term UDPI I'm showing here. So I'm just showing the UDPI output color-coded over the price history of Bitcoin. And you can see is that we are in a plausible place for an uptrend, right? When we see these green zones, those oftentimes can set the stage for these runs to the upside. We've seen this before. So that's certainly something that we like to see. And if we look at the raw output of the model, one other thing that I think is kind of bullish that suggests we've been able to maintain a bullish market structure so far with Bitcoin is that if we take a look starting all the way back at the final capitulation at the end of 2018 that really kind of started this market cycle, at least in a lot of people's opinions, we can see this macro uptrend in terms of the bottoming out of risk, right? That every time Bitcoin has capitulated since this macro bottom, it hasn't capitulated as far as it did at the start, right? It's realized a good amount of downside potential March 2020, but not as much as it could have, not all the way back down here. It didn't realize all of the realistic downside potential. Coming off of the highs back in the spring of 21, that capitulation in May and then into the summer, we didn't realize as much downside potential as we could have. And so we set in a macro higher low. And again, it seems like we're maybe doing that again. We got down below -3, but now it seems like we might be setting in a bottom in terms of long-term risk. And so from a macro perspective, this might just give us indication that we've maintained bullish market structure, right? That in these uptrends that Bitcoin puts in, oftentimes what you want to see is these higher lows in risk. And that's what we've seen throughout these different market cycles. And we're seeing it here again, which is good. That's something that we would like to see. That gives us confidence that maybe we are still in a bull market. Maybe a bear market isn't as likely to come, or we haven't seen evidence of a bear market yet from this perspective. Now, one thing I do want to talk about as well is look at the short-term UDPI, right? So the long-term cares about moves that play over multiple months. short term cares about moves that play out over days to weeks. So this will update a lot more quickly in terms of what it thinks is realistic in the coming days to weeks. So it's kind of caring more about that intra-day and week volatility, whereas the long-term UDPI is really caring about what's realistic in the coming kind of months, the longer-term perspective. And so obviously one of the things that we would be worried to see right now is if the short-term UDPI was cranked up to here, because that would be bearish. Oftentimes we see corrections off those points. And we're not there yet, right? We certainly are coming up. So Bitcoin is realizing short-term upside potential, which of course it is. It's rallying, right? That makes total sense. But we're not anywhere especially worrisome. And we're still below zero, which is, bullish bias. There's more realistic upside than downside potential in the short term. We like to see this. One of the things I'll be looking at is these kind of levels here, if we are able to get back to them, because these have this kind of 2.5 to 3, a little over 3 range, provided resistance in the last 2 rallies that we saw coming out of the summer and then coming out of late September, early October, and then ultimately getting up to above 3, which actually was kind of a warning sign at the time that all-time high in November was maybe getting a little bit overextended in the short term before we ended up having to correct. But certainly where we are right now would not be, this is not pessimistic, right? I think this is fine. And it just shows that we do still have short-term upside potential to realize. We'll have to see what happens. And now obviously with Bitcoin's price action, right, we don't have to just keep going up vertically, right? And in fact, I wouldn't expect that to be happening, right? I think that we're probably going to see some bumps in the road here on our way back up to these higher levels if we're able to get there at all, right? There are some really critical resistance ranges that we're going to be hitting. We're kind of hitting one right now around here. There's another big resistance range we're probably going to hit around here, 45, 46, 47, 48, kind of that general, call it 46K range is going to be a critical test if we get up to that point. And then ultimately these 50K range. And I've seen the 50K range be one that people have talked about a lot in the more macro side of things as being a really critical point. That if we can break that, that could be a sign that new all-time highs are likely. But that's going to be a really big battle potentially when we get there. So certainly we're not clear skies ahead yet, but things are looking good, and there's realistic upside potential that could happen, assuming we're able to break through those resistance ranges. So a couple other things I want to talk about before wrapping up here in this video. So one thing I do want to talk about is the stock market, because as I've been talking about before in the channel, my thesis has been that the real cause of this big macro downtrend for Bitcoin had been weakness in the stock market and concerns about, the Fed, tapering, not only tapering their bond purchases, but actually starting to distribute their balance sheet and then also raising interest rates. That's led to this kind of big macro uncertainty, the stock market not doing well. And we've seen the stock market potentially being able to put in a bottom here. And we're kind of just trading sideways right now. And so one thing you could say is like, well, isn't that bearish, right? That the stock market isn't just reclaiming all-time highs and going up. Well, I don't think that's necessarily the case, right? So certainly it's good that the S&P 500, that's what I'm showing you right now, is trading above the 200-day moving average, which is good. That's kind of a key support range you'd like to see it be able to hold. We had a red day, but one thing that I think is kind of notable is that the Bitcoin's been moving up, even though the S&P has actually been moving kind of down a little bit in the recent days, which up until this point had been kind of rare. Usually they've been trading in lockstep, where if S&P 500 was going up, Bitcoin was going up. S&P 500 going down, Bitcoin going down. There was kind of this one-to-one correlation that had been happening. We're seeing some decoupling here. And one thing that might be going on, now I think it's too early to know for sure, obviously, and this is a little bit speculative, but just something I think is worth mentioning, is that when you compare Bitcoin's price action to the S&P 500, there's some indication that Bitcoin can sometimes act as a canary in the coal mine, that sometimes it will make a move before the stock market does. So sometimes you can think of Bitcoin's price action as being a leading indicator for what might be coming in the stock market. Now, it's not always going to be the case, right? And there's a lot of noise. I kind of look at this more as maybe in those bigger macro events, sometimes this has signal. But obviously this is, you have to take this with a huge grain of salt, of course. But I just do want to mention this, so I think it's really interesting. So the first point I want to highlight is this weakness that we saw in the stock market in later 2018 that led in this big kind of correction that we saw before being able to move back up. And of course with Bitcoin, we know that Bitcoin was in a bear market at this time And then we got this ultimate capitulation that kind of marked the end of that bear market before we were able to start moving back up, start this new cycle that we've been in. And what you'll notice is that there had been some weakness in the stock market right before then, but kind of just trading sideways. But then what we saw was this huge capitulation by Bitcoin here. And then sure enough, the stock market followed after that to put in its final kind of big capitulation to the downside before being able to move back up. So you might have been able to see Bitcoin's price action as potentially a warning sign of impending capitulation in the stock market. You can go up to the COVID crash, which I think gives another interesting data point. So again, I'm showing you here this is the S&P 500, the candles, and then this orange line here is Bitcoin's price action. And again, you'll see a similar thing where they were kind of moving down together, but you'll see that Bitcoin capitulated, put in its ultimate capitulation before the stock market did. And then also, I think more interestingly, Bitcoin started recovering earlier, before the stock market really started recovering, which might have been a leading indicator that recovery was maybe going to come for the stock market, right? Bitcoin bottomed out several days, the 12th, whereas the stock market didn't bottom out until the 23rd of March 2020 before starting to move back up again. And then finally, you can see that in just more recent action as well, where of course, going into or coming out of the slump in October, you can see that Bitcoin shot up before the stock market moved back up. And then, of course, Bitcoin collapsing, dropping down precipitously from its all-time high in November, maybe was a warning sign the stock market could follow later. And so this was months in advance here, but the same kind of thing did happen. Now, does that mean that the same thing's playing out again, where Bitcoin's acting as the canary in the coal mine and really kind of moving up more convincingly than the stock market right now? We'll have to wait and see, but it certainly could happen. So that's one reason why I'm not really worrying so much about the current stock market price action. Like for now, I don't see anything especially concerning right now. It would be concerning if we have a big capitulation, of course, because then I think Bitcoin would be affected. But what could be happening right now is that even though we're not seeing a continuation of kind of explosive upside in the stock market, like we've been seeing kind of out of this bottom, this nice few days of green upside here, it could just mean that that's to come, right? If Bitcoin's going to act as a canary in the coal mine, if the Bitcoin rally continues, that could just be a leading indicator that the stock market will continue its rally as well, and that could lead to broader bullish sentiment. Now, of course, that's, as I said before, to take that with a huge grain of salt. No guarantee that could happen, but just something I think is interesting and something to keep an eye on there. All right, final things I want to talk about here, just to wrap us up with kind of this update about the Bitcoin rally. And so the one thing I do want to talk about is just the macro kind of setup from a long-term holder kind of perspective that just makes right now look not especially concerning, right, from more of an internal to Bitcoin perspective from the supply side. So I want to talk about the supply side here. So what I'm showing you here is the HODL waves of Bitcoin. If you're not familiar with this chart, essentially what it's looking at is age of coins since they've been moved last across different time frames, across different cohorts, essentially. So what you have is kind of the longest time cohort of coins that haven't moved for more than 10 years. So that's kind of the longest that Bitcoins have been held in this particular cohort. Then we have another cohort that's 7 to 10 years, that these coins have not moved in the last 7 to 10 years. Then 5 to 7, etc., going all the way down to 24 hours is the lowest time frame on this point here. And one thing that you can look at with these dynamics is this gives you just an idea of kind of long-term holder behavior, right? That the more Bitcoin that are in each of these older cohorts, right, as you get to 3 to 6 months, and then 6 months to a year, and then a year to 2 years, etc., the more coins that are in this phase, you might see that as just kind of broader sentiment in the market that higher prices are ahead, right? Because usually what will happen is that long-term holders tend to be the ones who hold their coins in these longer-term time frames, right? By definition, the longer-term holder you are, you're just going to be more of your coins are going to be in these cohorts right here. And so if you're holding, if you're not distributing, that might suggest that you're expecting higher prices to come, right? Otherwise you'd be distributing. If you're expecting a drawdown in the market, you might be selling off some of your coins that you've been holding for a while. And then those coins will join these shorter time frame cohorts, right? These longer term coins will move down into these young ones, right? They'll move down to 24 hours, then into the 1 to 8 a week, etc., as newer people bought them, as newer market participants potentially came in and bought those coins. So you can see with the HODL waves is that in these market cycle kind of peaks, you'll see this shift from these older coins moving into these younger cohorts, right? As the longer term holders sell or distribute their coins, they're bought by newer market entrants that then increases these shorter time frames here. And so those tend to coincide with these market cycle tops. And so that can be a warning sign, right? That can be a sign the market's starting to get overheated if people are distributing their older coins and then new entrants are buying them, and you're seeing an explosion in these younger cohorts. And we're not really seeing that right now, right? We'd had that bubble back in the spring of 2021, but now it seems like by and large we're just adding to these older cohorts, right? We're kind of getting this overall drawdown in the younger cohorts. There have been some selling that happened here, but by and large, we're just seeing an addition to these older cohorts here, which is what we'd want to see from a supply side. I think we can maybe see this a little bit more clearly if we just zoom in on just the 1 year HODL wave. So this is just the coins that are have been held for a year or longer. And so there's the number of those coins. And so what you can see here is that, again, you know, as you go into the market cycle peaks, you see a drawdown in the number of coins that are that old because people are selling those coins into that market strength. You know, if you bought it a year earlier, you're taking profit. And what we had seen is that throughout this kind of dip that we'd seen coming off the all-time high, this kind of explosion of 1 year old coins, where people who had bought a year previously were deciding, well, I'm not going to sell now. You know, I think higher prices are going to come. I'll just hold on to my coins. It's not worth it for me to take the money out, or it's not worth, you know, I'm willing to take the opportunity cost of leaving my money in Bitcoin because I think it's going to appreciate in the future. And that's what we're still seeing this in an uptrend. Slight slowdown in the recent days, but still moving up. I think that's something that you'd like to see. Now, of course, as price would continue to appreciate, you'd expect this to start dropping. But the longer that this is in an uptrend, the better. And the more sustainable, potentially, the longer lasting some ultimate rally could potentially be. So my overall take on Bitcoin right now, kind of from a short-term and a long-term perspective, is that I think we're starting to see the things that we want to see for this to be a meaningful rally. You know, obviously, there's risk associated with calling it now and saying that the bottom's in and that you can buy. You know, the earlier you confirm the trend, or you're convinced that the trend is reversed, the more risk you're always going to be taking on, but the more profit could be gained. But certainly I think we're on track. You know, I'm seeing a lot of good things right now with Bitcoin's price action. And then, of course, from here, we're going to have to watch these key resistance levels, and these are points to watch closely. And especially for people looking to de-risk, those might be ones that they're going to be watching quite closely. But just something to keep an eye on. I think fear is still in a good spot. The derivatives market is still largely, there's still a lot of doubt in the market, right? And I think we're not at a point where we're top heavy on the long side, so that's positive. And then, of course, just looking at the Max Pain price, you know, it's tracking the price quite closely right now, which is good. It means that there might not be a especially high amount of selling pressure trying to pull us back down, which is what we would like to see there. And then from our other perspectives, we're still at low risk. These are great, you know, from a more macro perspective. I think we're seeing the things that have oftentimes set up big rallies coming out. And the supply side, I think it's quite bullish right now. So a big surge in demand could certainly kind of set off the tinderbox, set off the powder keg, set us higher. And so really, if the stock market, if Bitcoin is going to be the canary in the coal mine again for the stock market, and we get broader bullish sentiment there, then I think, you know, bullish sentiment might prevail, might take over. But again, as with all of this, you know, you have to know what you're getting into, know the risks involved. You know, the best we can do is look at the data and make our own decisions of where we think we are. I am quite optimistic. You know, I'm not disbelieving this rally yet. I think that there's a lot to be hopeful for, but I'm not fully believing it either. You know, I think that we still have a little bit to show before I'm going to be convinced that this is the rally that takes us to all-time highs. But again, so far, so good. Not financial advice. We'll see what happens. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. Remember, with UDPI, we're all going to make it.